Let me ask you a question that reveals everything about how you think about money. If you had to choose right now today to put all of your wealth into either stocks or bonds for the rest of your life, with no ability to ever switch, which would you choose? Most people freeze when I ask this question. They start hedging. They want to talk about diversification. They want to ask about their age and risk tolerance and time horizon. But that is not what I asked. I asked you to choose one or the other forever. I have been investing for over 70 years. I have lived through 14 recessions. I have watched the stock market crash by 50% or more on multiple occasions. I have seen interest rates go from 2% to 20% and back again. I have studied every major financial crisis in American history, and I can tell you with absolute certainty which choice I would make. It is not even close. And by the end of this discussion, you will understand exactly why. But first, let me take you back to 1942, because that year shaped everything I believe about this question. I was 11 years old. I had saved up $114.75 from delivering newspapers and selling golf balls and various odd jobs. My sister Doris had saved a similar amount together. We bought 3 shares of a company called City Service, preferred at $38.25 per S-hair. Now here's what matters about that story. I could have put that money somewhere else. I could have bought government bonds in 1942. You could buy Series E savings bonds that paid 2.9% interest, guaranteed by the United States government, completely safe. No risk of loss. My father, who was a stockbroker, could have easily helped me buy those bonds instead. But I chose stocks. At 11 years old, I intuitively understood something that most adults never figure out. Over long periods of time, ownership of productive businesses beats lending money to others. It was true in 1942. It was true in 1972. It was true in 2002. And it will be true in 2052. That $114 I invested in 1942, if I had put it in stocks and simply let it compound at the historical average return of the stock market, would be worth over $5 million today. If I had put it in bonds at the rates available, then it would be worth maybe $15,000. The difference is not small. It is life-changing. It is the difference between wealth and mediocrity. Now, let me give you the framework for why this is true, because understanding the why is more important than just accepting my conclusion. There are 4 fundamental reasons why stocks beat bonds over the long term. First, stocks represent ownership of productive assets that grow, while bonds represent loans that simply return your money with interest. Second, stocks provide natural protection against inflation, while bonds are devastated by inflation. Third, the mathematics of compounding favor assets with higher returns, and the gap widens dramatically over time. Fourth, human ingenuity and economic progress continuously create value that flows to business owners, not to lenders. Let me take you through each of these reasons in detail, because once you truly understand them, you will never again be confused about the choice between stocks and bonds. The first reason stocks beat bonds is the fundamental difference between owning and lending. When you buy a bond, you are lending money to someone, either a government or a corporation. They promise to pay you interest and return your principal at maturity. That is the entire deal. You get a fixed return, and then you get your money back. There is no upside beyond what was promised. If the borrower does spectacularly well, you still get the same fixed payment. You are a creditor, not an owner. When you buy a stock, you are buying ownership in a real business. You own a piece of the factories, the equipment, the inventory, the intellectual property, the customer relationships, the brand value. You own a share of the profits, and crucially, you own a share of the growth. If the business expands and becomes more profitable, your ownership stake becomes more valuable. There is no ceiling on your returns. Think about what this means over decades. A bondholder who lent money to a company in 1980 got their interest payments and their principal back. That was it. A stockholder who bought ownership in the same company in 1980 might have seen their investment multiply 10 times, 20 times, or even 100 times if they chose the right company. I have owned shares in one of the largest technology companies in the world for many years now. My cost basis on those shares is a fraction of what they are worth today. The dividends I receive each year exceed what I originally paid for the stock. That is the power of ownership. A bondholder in that same company would have received their 4 or 5% interest and nothing more. The same principle applies even if you do not pick individual stocks. The entire stock market represents ownership of American business, and American business as a whole has grown enormously over the past century. Revenues have grown, profits have grown, dividends have grown, the value of ownership has grown, bondholders have received their fixed payments and nothing more. Let me put some numbers on this to make it concrete. In 1928, the Dow Jones Industrial Average was around 300. Today it is over 40,000. That is an increase of more than 130 times. And that does not even include dividends, which would more than double the total return. $1 invested in the stock market in 1928 would be worth over $7,000 today. Now consider bonds. In 1928, you could buy long-term government bonds yielding about 3.5%. If you reinvested all your interest, $1 invested in bonds in 1928 would be worth about $30 today. Not $7,030. The stock investor has 230 times more money than the bond investor. This is not a small difference that you can ignore. This is the difference between retiring wealthy and retiring worried. This is the difference between leaving a legacy to your grandchildren and leaving them nothing. I want you to really think about what this means for your life. 230 times is not an abstraction. If the bond investor has $100,000 at the end, the stock investor has $23 million. If the bond investor can afford a modest retirement, the stock investor can fund generations of their family. If the bond investor worries about running out of money, the stock investor has more than they could ever spend. This is why I get frustrated when I hear financial advisors telling young people to put 40 or 50% of their savings in bonds. They are robbing those young people of their futures. They are condemning them to mediocrity when they could have wealth, and they are doing it in the name of safety, when the real risk is not volatility, but the failure to build adequate wealth. I understand why people feel comfortable with bonds. There is something psychologically reassuring about knowing you will get your money back. The stock market can feel like a casino where anything can happen. But this comfort is an illusion. The safety of bonds is a mirage that evaporates when you account for inflation and the opportunity cost of missing stock market returns. The second reason stocks beat bonds is inflation. Inflation is the silent killer of bond investors. It erodes the purchasing power of your fixed payments year after year until what seemed like a comfortable income becomes barely enough to survive. Let me explain how this works. When you buy a bond paying 5%, you think you are earning 5%. But if inflation is 3%, you are only earning 2% in real terms. Your purchasing power is only growing by 2% per year. And if inflation spikes to 6 or 7%, as it did in the 1970s, and again recently, you are actually losing purchasing power every year, even though you are receiving interest payments. I lived through the great inflation of the 1970s and early 1980s. It was devastating for bond investors. Someone who bought a 30-year Treasury bond in 1972 yielding 6% thought they had locked in a good return. But inflation averaged over 8% for the next decade. Every single year, the purchasing power of their bond income declined. By 1982, when their bond matured, the dollars they received back could buy less than half of what the original dollars could have bought. Stocks are fundamentally different. Businesses can raise their prices to keep pace with inflation. If the cost of inputs goes up, companies raise the prices they charge customers. If wages go up, companies raise prices, the nominal value of business assets. Revenues and profits tends to increase with inflation, and since stocks represent ownership of businesses, stock prices tend to rise with inflation over time. This does not mean stocks are immune to inflation in the short term. High inflation often comes with high interest rates and economic disruption, which can hurt stock prices temporarily. But over the long term, stocks provide natural inflation protection that bonds cannot match. Consider the extreme case. If inflation averaged 10% per year for the next 20 years, a bond paying 5% would be a catastrophe. You would lose purchasing power every single year. At the end of 20 years, your money would buy less than 1/4 of what it buys today. But stocks, companies would raise their prices. Revenues and profits would grow nominally. Stock prices would rise. You might not fully keep pace with 10% inflation, but you would do far better than the bond investor losing 5% of purchasing power every year. This inflation vulnerability is why I consider bonds to be among the most dangerous investments for long-term investors. People think bonds are safe because the principal is guaranteed. But what good is getting your principal back if that principal can only buy half of what it could when you invested? You have not preserved your wealth. You have lost half of it. I have seen this devastation firsthand. I have watched retirees who thought they were set for life with their bond portfolios slowly realize that their income was not keeping pace with their expenses. Every year, the gap widened. Every year, they had to cut back a little more. The bonds kept paying their fixed interest, but that interest bought less and less. These people did everything right by the conventional wisdom. They saved diligently, they invested conservatively, they avoided the scary stock market, and they ended up running out of money or dependent on family members because inflation ate their purchasing power alive. The cruelest part is that these investors never saw it coming. Inflation works slowly, invisibly, relentlessly. You do not wake up one day to find your money is worth half as much. It happens so gradually that you barely notice until you realize you can no longer afford the life you planned. Stocks protect you from this silent destruction. Not perfectly, not in every single year, but over time. Stock returns have consistently outpaced inflation by a wide margin. A stock investor who earned 10% while inflation ran at 3% built real wealth at 7% per year. A bond investor who earned 4% while inflation ran at 3% barely kept their head above water. The third reason stocks beat bonds is the mathematics of compounding. This is the most powerful force in investing, and it overwhelmingly favors the asset class with higher returns. Let me show you how this works with a simple example. Imagine you have $100,000 to invest for 30 years. In scenario 1, you invest in bonds earning 4% per year. In scenario 2, you invest in stocks earning 10% per year, which is roughly the historical average after 30 years. The bond portfolio is worth $324,000. Not bad. You have more than tripled your money. After 30 years, the stock portfolio is worth $1,745,000. You have turned $100,000 into nearly $1.75 million. The stock investor has 5 times more money than the bond investor. 5 times. And this is using conservative assumptions for stock returns. In many 30-year periods, stocks have done significantly better than 10% annually. But here is what makes this really interesting. The gap between stocks and bonds does not grow linearly. It grows exponentially in year 1. The difference is only about $6,000 in year 10. The difference is about $100,000 in year 20. The difference is about $400,000. In year 30, the difference is over $1.4 million. This is the magic of compounding. Small differences in annual returns become enormous differences in terminal wealth over long time periods. A 6% difference in annual returns, compounded over 30 years, turns a 3-to-1 ratio of initial returns into a 5-to-1 ratio of final wealth. Now extend this to 40 years, which is roughly the investing lifetime of someone who starts at 25 and retires at 65. At 4% for 40 years, bonds turn $100,000 into $480,000. At 10% for 40 years, stocks turn $100,000 into $4,530,000. The stock investor has nearly 10 times more money. This is why I tell young people that the most important financial decision they will ever make is choosing stocks over bonds for their long-term savings. The mathematics are simply overwhelming. Every year you spend in bonds instead of stocks is a year of lost compounding that you can never get back. I call this the great tragedy of conservative investing. Well-meaning people, often advised by well-meaning financial professionals, put their money in bonds because they want to be prudent. They sacrifice a few percentage points of return in exchange for lower volatility. It seems like a reasonable trade-off, but over 30 or 40 years, those few percentage points become millions of dollars. The conservative investor looks at their bond portfolio and sees stability. What they do not see is the fortune they gave up, the wealth that could have been theirs, the legacy they could have left, the freedom they could have enjoyed. I am not saying everyone should take maximum risk all the time. Risk management matters. But for long-term money, the conservative choice is actually stocks, not bonds. The real risk is not volatility. The real risk is not building enough wealth to fund your goals. And bonds, with their lower returns, virtually guarantee that you will fall short. The fourth reason stocks beat bonds is human progress. This is the reason that underpins all the others. And it is the reason I am so confident that stocks will continue to beat bonds in the future, just as they have in the past. Human beings are ingenious. We solve problems. We create new technologies. We find more efficient ways to do things. We build businesses that serve human needs in better and better ways. This progress creates economic value, and that value flows to the owners of businesses. Think about what has happened in just my lifetime. When I was born in 1930, there were no computers, no jet airplanes, no antibiotics, no interstate highways, no internet, no smartphones. The average American lifespan was 60 years. Most people did not have air conditioning or television. International communication meant sending a telegram today. We carry supercomputers in our pockets. We can video chat with anyone in the world instantly. We have medicines that cure diseases that were death sentences in my childhood. We can fly anywhere on Earth in a day. The average American lifespan is approaching 80 years. The quality of life has improved beyond anything my parents could have imagined. All of this progress was driven by human ingenuity applied through businesses. People started companies, they invented products, they improved processes, they created value, and the owners of those businesses captured that value through rising stock prices and dividends. Bondholders participated in none of this. A bondholder in 1930 received their fixed interest payments and their principal back. They did not benefit from the invention of the computer or the internet or the smartphone. They did not share in the profits of the companies that created the modern world. They simply got their contractual payment and nothing more. I see no reason why this pattern will change in the future. Human beings will continue to innovate. We will continue to solve problems and create new technologies. Artificial intelligence, biotechnology, clean energy, space exploration, the opportunities for progress are enormous. And that progress will create value that flows to business owners, not to people who simply lend money. This is why I am so confident in stocks over the long term, despite all the short-term volatility. I am betting on human progress. I am betting that people will continue to create value through businesses, and that bet has paid off for the entire history of modern capitalism. Some people ask me if I worry that the future will be different from the past. What if stocks do not beat bonds going forward? What if something fundamental has changed? I have thought about this question carefully, and I always come back to the same answer for stocks to stop beating bonds. One of two things would have to happen. Either human beings would have to stop innovating and creating value, or the benefits of that innovation would have to stop flowing to business owners. Neither of these seems likely to me. Human ingenuity is not going away. People will continue to solve problems, invent new technologies, and build businesses that serve human needs. And as long as they do, the owners of those businesses will benefit, could there be periods, even long periods, where bonds beat stocks. Of course, there have been such periods in the past. The 1970s were terrible for stocks relative to their historical average. So were the 2000s. But even during these difficult periods, stocks eventually recovered and resumed their long-term outperformance. The key is having a long enough time horizon. If you are investing for the next 30 or 40 years, the odds overwhelmingly favor stocks. The historical record is clear. The mathematics are clear. The fundamental logic is clear. Now let me address the objections, because I know what you are thinking. What about the crashes? What about 2008? What about the Great Depression? What about all the time stocks have fallen 50% or more? These objections are valid, and I take them seriously. Stocks are volatile. They can and do fall dramatically in the short term. If you bought stocks at the peak in 2007, you lost more than 50% over the next 2 years. That is terrifying. That can ruin your retirement if you are forced to sell at the bottom. But here is the crucial insight. Volatility is not the same as risk. Volatility is the day-to-day and year-to-year fluctuation in prices. Risk is the probability of permanent loss of capital. These are completely different things. When stocks fall 50%, they are volatile. But if you do not sell, you have not lost anything permanently. You still own the same businesses, you still receive the same dividends, and eventually prices recover. They always have. The stock market has recovered from every single crash in history. 100% of them bonds, by contrast, have much lower volatility but much higher risk of permanent loss through inflation. If inflation runs higher than your bond yields for a decade, you have permanently lost purchasing power that you will never recover. The dollars you get back will never buy what they would have bought when you invested. So when someone tells me bonds are safer than stocks, I ask them, safer from what? Safer from short-term volatility? Yes. Safer from permanent loss of purchasing power? Absolutely not. And for a long-term investor, it is the permanent loss that matters. I think about risk constantly. It is one of the most important concepts in investing. But most people think about risk completely backwards. They focus on the risks they can see and feel. Like stock market volatility, they ignore the risks that are invisible but far more dangerous, like inflation erosion and the failure to build adequate wealth. The greatest risk in investing is not losing money in a market crash. The greatest risk is not having enough money when you need it. The greatest risk is reaching retirement age and realizing that your conservative bond portfolio cannot support the life you expected. That is a risk you cannot recover from. That is a permanent impairment to your quality of life. Stocks may be volatile, but they give you the best chance of building the wealth you need. Bonds may be stable, but that stability comes at the cost of lower returns that may leave you short. If you understand this trade-off clearly, the choice becomes obvious. Let me share a story that illustrates this perfectly. In 1974, the stock market had crashed. The Dow was down over 40% from its high. Inflation was raging. The economy was in recession. Vietnam had just ended disastrously. Nixon had resigned in disgrace. The national mood was terrible. At that moment, many investors fled to bonds because they wanted safety. Government bonds were paying decent yields, and they seemed so much safer than stocks that kept falling. It felt like the rational thing to do. But those investors who fled to bonds in 1974 made a catastrophic mistake. Over the next decade, inflation averaged over 8%, devastating their bond returns. Meanwhile, the stock market, which looked so dangerous in 1974, began one of the greatest bull runs in history. By 1984, stocks had more than tripled. By 1994, they had increased tenfold. The investors who bought bonds in 1974 felt safe. They avoided the volatility, but they missed the greatest wealth creation opportunity of their lifetimes. They traded short-term comfort for long-term regret. This pattern repeats in every market crisis. At the bottom, when stocks look most dangerous, that is precisely when they offer the best long-term returns. And at those moments, bonds feel safe but are actually most dangerous because they lock in low returns during a period of recovery. I am not saying you should have 100% of your money in stocks. I am not saying bonds have no place in a portfolio for money you need in the next few years. For an emergency fund, for specific short-term goals, bonds and cash make sense. You cannot afford volatility with money you need soon. But for long-term wealth building, for retirement savings, you will not touch for decades. For money you want to pass to your children and grandchildren, the choice is clear. Stocks beat bonds, ownership beats lending. It has been true for the entire history of modern financial markets. And it will continue to be true for as long as humans keep innovating and creating value through businesses. Let me tell you how I have applied this principle in my own life and at my company. At Berkshire Hathaway, we hold very few bonds. Almost all of our investment portfolio is in stocks. We own pieces of wonderful businesses, and we let those ownership stakes compound over time. This approach has made Berkshire one of the most valuable companies in the world. For my personal estate, I have given instructions to my trustee for how to manage my wife's inheritance. I told him to put 90% in a very low-cost stock index fund and 10% in short-term government bonds. Not 50-50, not 70-30, 90% stocks. If that allocation is good enough for the people I love most in the world. It should tell you something about my conviction. I am not recommending stocks over bonds because I read it in a textbook. I am recommending it because I have studied this question for 70 years, and I have staked my own wealth and my family's wealth on the answer. Now let me bring this to a close with some practical thoughts on implementation. If you accept my argument that stocks beat bonds over the long term, what should you actually do? First, determine your true time horizon. If you are 30 years old and investing for retirement, your time horizon is 35 years or more. That is long enough to ride out any market crash in history. You should have very little in bonds. If you are 65 and retired, your time horizon is still 20 or 30 years for money you will not need until late in retirement. Even retirees should have substantial stock allocations for their long-term money. The mistake many retirees make is thinking their time horizon ended when they stopped working. But if you are 65 and might live to 95, you have a 30-year time horizon for money you will not spend until your 80s and 90s. Only money you need within the next few years should be in bonds or cash. That money cannot afford volatility because you cannot wait for a recovery. But that should be a relatively small portion of your total portfolio, enough to cover a few years of expenses, not half or more of your wealth. Second, embrace volatility rather than fearing it. When stocks fall, that is not a reason to sell. That is an opportunity to buy. The lower prices go, the better the future returns will be. Some of the best investments of my life were made during periods of maximum fear and pessimism. I remember buying stocks in late 2008 and early 2009 when everyone was convinced the financial system was collapsing. The prices were incredible. The fear was palpable. And the returns over the following decade were extraordinary. Those who fled to bonds missed one of the greatest bull markets in history. Those who embraced the volatility and kept buying stocks were richly rewarded. Third, invest consistently regardless of market conditions. Do not try to time the market. Do not wait for the perfect moment. The perfect moment never comes, and waiting costs you the returns you would have earned while waiting. Just keep investing in stocks month after month, year after year, and let time do its work. I have seen so many investors try to be clever about timing. They wait for a crash to buy. They try to sell before downturns. Almost all of them fail. The market is impossible to time consistently. The smartest approach is to ignore timing entirely and just keep investing through all conditions. Fourth, keep costs low. The difference between a 1% annual fee and a 0.1% annual fee might seem small, but over 30 years it costs you hundreds of thousands of dollars. Buy low-cost index funds. Do not pay active managers to underperform the market. The investment industry has convinced many people that you need expensive advice and active management to succeed. This is false. A simple, low-cost stock index fund will outperform most actively managed funds over time. The fees you save go directly into your pocket rather than into the pockets of financial intermediaries. Fifth, ignore the noise every day. There are headlines designed to scare you every month. There are experts predicting crashes every year. There are reasons to worry. Ignore all of it. The long-term trajectory of human progress and stock market returns has been up and to the right for over a century. That is not going to change because of whatever crisis is in the news today. I have lived through more crises than I can count. Wars, recessions, political turmoil, financial panics. In the moment, each one seemed like it might be the end of the world. In retrospect, each one was a buying opportunity. The stock market has overcome every challenge thrown at it, and it will continue to do so as long as human beings keep innovating and creating value. The question I asked at the beginning has a clear answer. If I had to choose between stocks and bonds forever, I would choose stocks without hesitation. It is not even close. The mathematics, the history, and the fundamental nature of ownership versus lending all point to the same conclusion. Stocks represent ownership of human ingenuity and progress. Bonds represent loans that return your money with a fixed payment. Over any long time period, ownership beats lending. It always has. It always will. The choice is yours. You can accept volatility and build wealth over time through stock ownership. Or you can avoid volatility and watch inflation slowly erode your purchasing power through bond ownership. You can participate in human progress, or you can sit on the sidelines collecting fixed payments while the world moves forward without you. I know which choice I have made for 70 years. I know which choice I am making for my family. And I know which choice will serve you best if you have the patience and discipline to stick with it through the inevitable ups and downs. Choose ownership. Choose stocks. Choose to participate in the greatest wealth creation machine in human history. Your future self will thank you.